All right, so we are recording. So, like I said, we have a couple of different things I'm going to cover today. We'll do it in a couple of different sessions. We're going to start off with researching a company. We're going to move into diversifying your portfolio, then go into charting, TA, and then some indicators. All right, this is not going to be super advanced. I'm going to try to keep things on a simpler level, but as always, if you do have questions, please ask. We're going to start off with researching companies. We're going to start off with FinViz. All right, so FinViz, for those who don't know, is a screening website. It's free to use. They do have a paid version, but you can do a lot with the free version. Okay. And what you want to do if you're going to be looking for, this is again from I'm trying to find companies to invest in, and investing is when you're holding it long term, which technically is just over a year as far as taxes are concerned. So we're looking for something that we want to hold long term. There's different ways you can go about it. I think I'm going to kind of end up mixing the diversification and researching pieces together. There's different ways you could do it. Right. So we have the value investments. Value investing is kind of like looking at, for example, if you're into sports at any capacity, you might know who LeBron James is. You might know who Steph Curry is. Right. When LeBron came into the league as a rookie, he skipped college. He was 18 or 19. I think he was 18. But it was all eyes on LeBron. Everybody knew who LeBron was. He had just fresh, right? Just barely an adult, couldn't drink legally. But everybody knew who LeBron was. Everybody was watching to see what he was going to do. There were high expectations. I'm breaking up. That's not good. Get off of that. Can you hear me? Am I good? Am I good? Am I good? Uh-oh. I'm trying to kill it. Bet. All right, cool. Rhonda said yes. I appreciate you. Like I said last time, I had like a bunch of devices around me and they're all on the same Wi-Fi. And maybe I'm eating Wi-Fi from myself. But if at any point my connection goes out a little bit, just please put something in the chat. So, like I was saying, everybody know who LeBron was. All right, cool. We all know who LeBron is still. When Steph Curry came in the league, he wasn't even a starter. He was playing behind Monte Ellis. They almost traded him, if I'm not mistaken. But he was just a guy that they picked up from this random school. He was good, but he's that value pick. Nobody expected for real that Steph Curry would become this big superstar that's practically he's one of the major faces of the league now. He's the best shooter of all time statistically, right? Nobody was looking for that. Nobody expected that. So that's where value investing is. Value investing is you neglecting the LeBron that everybody knows about. We have these high hopes, have these high expectations, and saying, okay, I'm trying to find a Steph. What's something that is a little under the radar, right? And so there's a couple of different things that we can look at to start looking for those. So I wanted to start off on FinViz. I wanted to pull up the screener. If you can also follow along as well if you have multiple screens. But there's certain stuff that we're going to look at. Okay. First and foremost, you want to make sure that you're investing in a solid company. We have all these different terms. If you're new to FinViz, if you're new to investing, luckily for you, these terms, you hover over them, they will give you an example of what the thing means or a definition. All right. So return on assets, or ROA, is an indicator of how profitable the company is relative to its total assets. How efficient are they managing their assets? All right. These are all different things we want to look at. Return on equity is how they're, when it comes to equity, how are they managing the money? So we want to look at a couple of things. All right. So first off, let's say that we're looking for companies, and this is something that I like to do. I don't want to invest in something that's super cheap. That's just me. But we're screening to find opportunities. All right. We're not trying to find, the Amazon that's already Amazon. We want to find something that has potential to continue to grow into that. So if we're looking for stuff like that, then maybe we can have a certain price filter, like, okay, over $5. All right. We want to see stuff that has increasing earnings per share and increasing sales. All right. Sales growth. We don't want to invest in a company that sales growth is declining. All right. So let's say over 10% for now, just to start weeding out certain things. Return on equity. Let's look for something that has positive return on equity, positive return on their assets. All right, your PE ratio. This is your price to earnings, and this is kind of one of the easier ways, in short, to use as a metric to gauge valuation. All right, when something has a very high price to earnings, then you're looking at something that's being overvalued, and that doesn't mean that the stock can't keep going up. And we'll look at some examples. That doesn't mean that the stock can't keep going up, even on a slow growth economy. Yeah, I'm gonna come back to that. Oh, but what that does mean is it's already people are pouring money into it, just thinking it's gonna keep going. So LB put in the chat, even with the slow growth economy. And for me, the answer is yes, because if we can identify companies that are excelling or still performing or holding their weight in a slow growth economy, then that means they should be able to, and of course you want to get into deeper stuff, but it should be able to hold their own when the economy isn't doing much. And when the economy is doing well, that company should increase as well, right? Kind of like how if you're looking at SPY going up, okay, SPY is going up, we're assuming that Apple and Amazon are up and Microsoft is up too, right? That's not always the case. But yes, even when the economy is slow, if we find companies that are excelling or holding up, then when the economy is better, assuming that wasn't a direct correlation, then we can look at that for something that's going to keep going. All right. But that's just some of the things that you start going through. And we can, again, just take these different things. PE, we want it to be lower, right? We don't want something that's super high. We want something that's lower. That's going to give us those stocks that are under the radar, right? Something that's under 25, under 20. That's when you start to get to names you don't recognize as much. Market cap, you can go large. You can go big. Ty in the Shay. Feel free to pop your question in the chat. Matter of fact, I'll let you unmute. We could do that. Let's interact.
I'm getting a little bit of loss because I see, you know how you pulling in the filters? I don't see that on my end to add all that. So I was just wondering if somebody can guide me really quick because I'm getting
Are
left
you under
behind.
the all, or are you under one of the other tabs?
Let me see. Hold on. Can you see my computer screen? I don't know. I can't work. Do you see it?
I see you.
How about now?
Yes.
Okay. You see, I got to the price over here, but after I got to the price, I got
you might have
lost.
the screen background, the background blur on, but do you see where it has descriptive, fundamental, technical, or all?
Uh-huh.
Do you have all clicked?
No, that's what it was. Thank you.
You're welcome. Good question. Good question. Okay. So, that's stuff that we start looking at to start sorting out of all the companies that exist. Well, how do we put ourselves in a solid position as far as what we're going to look to invest in? All right. So we're looking at stuff that has positive sales growth, has positive earnings per share growth projected. All right. Past sales growth going up. All right. And so when you start doing that, then you start dropping it down to companies that are really solid companies fundamentally. And of course, fundamentally, it doesn't mean they're going to go to the moon, but you can be sure that you're investing in something that has solid backing behind it. Okay. So I'm going to leave this be for now, because we, like I said, we have a lot of different stuff we're going to go into. But just, again, come to FinViz, look at some of these things and start utilizing these filters like Ms. Martin did to be able to see, hey, this is telling me that this is going to show quarter over quarter growth of a company's profit allocated to each share, right? Per share, how much profit are you generating? I want to see that positive. How's your sales growth quarter to quarter? Are you getting more sales consistently? Right, that's the type of stuff we want to look at. So sliding down to Yahoo Finance, Yahoo Finance is another great website for you to be able to look at choosing companies and selecting companies because you can see these numbers, a lot easier. You can see their PE ratios and what it's looking like. You can see the beta and how volatile is it compared to the overall market. All right, you can see the lows, you can see the profit margin. And so again, there's a lot of stocks out there where they're not making a profit. And that doesn't mean that the stock is bad. It just means that when you're looking at, again, the diversification part comes in. If you're looking at how you're allocating your money, You don't want to put all your money in companies that aren't making money unless you have a more high risk. I just want one winner, right? But we want to, for the most part, if we're looking at our long-term investments, we're looking at those to be the safer trades or the safer investments, safer spots for putting our cash. If you were choosing a company to invest in just regularly without thinking about this, hey, bro, I got a company I'm starting. You want to invest with me? Are you profitable? No. Hey, bro, I got a company. You want to invest with me? Are you profitable? Yes. Before finding out more details about the company, you're going to talk to a person who's profitable a little bit more, right? So Tesla, Amazon, a lot of companies did start off not profitable in the beginning, and then they grew and blew up, right? As you can kind of assume, a lot of companies that started off not profitable continue to be not profitable and end up going bankrupt, right? So that's something to look at as well. So you can come to Yahoo Finance. You can see the percentage of shares that are held by institutions, shares that are held by insiders, the short ratio, which is how much of their shares are actually being shorted. Are big companies putting bearish positions on here? Are they shorting the stock? Because when you see that, we had those big short squeezes with the meme stocks and everything. But when you see that, you can start looking at it from the standpoint of, hmm, they're betting against this heavily. Right, if we see high short, or if we see that the institutions aren't holding this, these institutions, I'm not going to say they just move the markets, but they move the markets. Right, they have all the research, all the, as soon as this happens, before it even happens, they know about it. Right, so using that is a good metric that I like to look at, because before Jordan knows, like, oh, this is the hot stock tip, right? These institutions that research this stuff all day and have full teams devoted to this and have been doing this all their lives, they probably look at this, right? So looking at that, coming in, comparing cash flow statements as well, you can start looking in those things. We're going to look at that on TradingView too, where we look at their actual statements, right? So TradingView, if you go to any chart for any company, I'll go to Nike, for example. If we were to go to Nike and we click on that E, that earnings E at the bottom, we can look at more financials. So you can access it on this side as well, if I'm not mistaken. Put that on and you can go to it too. But if we go to Nike financials, here we can see a lot of the same stuff. All right, we can see valuation ratios. We can see revenue to profit. We can see their performance with profit margin, right? Profit margin declined from 2021 to 2022. All right, we see revenue went up. So they had more money come in, right? But their actual net profit decreased and their profit margin decreased. And that's stuff that we can start to ponder on and look at and think about. I'm gonna go to Netflix, because Netflix is very interesting. So we all know Netflix and we're familiar with it. And we saw Netflix was one of the companies that had a big boost coming out of the COVID drop. All right. So obviously, with people working from home, kids being at home, and this is just like stuff to think about as much as you can. Of course, you do your research, but it helps when you can have an understanding of the dynamic of a company. So yeah, Netflix was shooting up. Netflix tapped $700, and Netflix was benefiting from people being at the home, because more people being at home leads to more time spent streaming, which is where Netflix gets their money from. So when you consider that, and everybody started going back to work, kids going back to school, Netflix isn't going to be having the same amount of people engaged with it, the same amount of subscribers continuously buying into it, right? So think about that. Think about the competitors, and this is any stock, right? And for any stock that you're interested in, you're just one Google search away from searching up Nike competitors, Texas Instrument competitors, Dollar Tree competitors. So if we look at Netflix, for example, we know that I'm using this because it's public knowledge and it's easy. We all kind of know it. Like Disney Plus, the release of Disney Plus and Hulu. You see Hulu ads on TV. Hulu has live sports. There's so many new streaming services, YouTube TV, so many different ones that are coming into this where they're directly challenging what Netflix has been known for. And Netflix was like the first to really make that innovation, but now everybody's doing it. Right. So what is Netflix going to do different to show why it deserves to be so high? Or are there other opportunities that are better? Right. So if we come in and look at the financials, then we can come and look at Netflix, and we see something similar with Nike, where their profit margin declined. It was going up. We see a profit margin declined. We can drop in, scroll down a little more. Let's go to statements. All right. So we can start looking at the cash from their operating activities, uh, and just really dig into how their cash flow is changing month over month or quarter over quarter, year over year. We can look at their free cash flows and see that the free cash flow um, is increasing, right? Very good. And that's something we want to pay attention to. We want to find companies that have high free cash flows. We can look at the balance sheet and look at their assets and see, are their assets increasing, right? And if you don't know, again, just like FinViz, boop, right? Your assets are those things like cash, positive debt, but that's the stuff that's building into the company for the future. We can look at the liabilities and see if they're increasing. A lot of times, liabilities, although it's a term that kind of is like a negative association, um, especially like expenses as well. If they're increasing, sometimes it's research. I like companies that were originally, not profitable. A lot of times they're spending their money so much on research and development that they're going to be non-profitable. But they have the big, seed funds and all of that. And then total equity year over year. So these are things you want to see assets increase. You want to see equity increasing, right? Debt is a little interesting because you can get into spots where they're taking on too much debt. It looks like they're starting to drop, right? So they're getting rid of some debt. And then flying over to the income statement, which is another one of the things I like to look at. Cause I do like to look at the gross profit a lot, net income, and see just how is the money flowing. All right. So kind of like something you would do with yourself. How is your money flowing? Are you turning a profit? I only want to invest in companies that are profitable companies. If it's a solid company and they're not profitable right now, that's fine. I'll invest in them when they're profitable. All right. So looking at revenue year over year, we're seeing that revenue is still picking up. All right. We're seeing that profit is still picking up as well. Good question. What's a good revenue to debt ratio? So revenue to debt ratio, I don't have an exact number, I would say. I just like hard look for. What I would want to do is then look at I want to look at the I don't have a hard number. I don't have a hard number. That's something I would have to think about how I normally handle it. Because I don't want the debt to be so much that maybe double. I don't have a hard number though. So I don't want to give you an answer that I don't have. But good question though. I appreciate the question. That's something for me to kind of figure out when I see these numbers. There's something I do in my mind where I'm like, okay, it's worth it. Okay, it's not worth it. But I don't have a hard number. For a lot of the other things though, like return on equity, I look for 20%. Sales growth, I usually look for 20%. Earnings per share growth, I usually look for around 20% as far as year over year. So as far as that though, yeah, that's how I'm looking at it. So yeah, good question. I like that because I don't have an answer. All right, rolling though, rolling. So yes, TradingView is a great spot to come in again and look at the different things, see where money is flowing, see, like I said, streaming services was picking up, DVD is dropping, international streaming, domestic streaming, and this is stuff that we can then go compare. We could pull up Disney Plus numbers or Hulu and see how much market share we're losing. Right, Netflix streaming revenue is still increasing. So we can't really say that they're losing so much market share in the streaming area that it's causing them to start losing, money year over year. Not yet. But if that's something that you start to see, then that's something that can kind of cue you off to leave it alone. All right. And then the last site that I like to look at is Open Insider. And the reason I like to look at Open Insider is because it's going to tell me when people who are CEOs, CFOs, COOs, 10% shareholders are making purchases or sales of a certain company. And so if we go look at Netflix and pull it up, now we see some sales and options being exercised. All right, so people getting rid of shares or exercising their options. But seeing certain stuff, I'm gonna go to Snapchat. I think Snapchat was like all sales. Right. So if I'm looking at a company and I'm looking at the people who are in the company, obviously you're only going to buy stock if you're anticipating the price of the stock to go back up. You're thinking that the company you're in is undervalued. Right. Selling comes for different reasons. A lot of people will sell, for new opportunities. Companies or shareholders might sell to, again, fund different projects within the company. There's a lot of different ways you go about it. But when I look up a company and I see that, over the past year, this is all 2023 here. All right, COOs, GC, CFO, COO, CFO, CAO. All right, they're all just selling off Snapchat shares. CEO. All right. So when I see that, that's something that will say, okay, I did the research, I looked at the stock, but seeing that the company, like the insiders of this company, are not interested in holding these shares, starts to kind of push me away when they haven't made any big purchases within the past year, 2 years. Right. So when it comes to diversifying, like we were saying earlier, you have your growth stocks, you have your value stocks, and you have to look at yourself and your actual trading goal and your investing purpose. Right? Is it a speculative approach where you're looking to just see if you can throw $1,000 on 20 different companies that just IPO'd and maybe one of them hits? Is it more of a building up the long term so you can have something to retire and pay yourself out from? Are you going into dividends more so? Are we looking at dividends and analyzing those? I'm gonna add another way I like to look at companies too. So when you're diversifying, there's not a set. That's the reason I say is because there's not like a set rule for how you want to spread your money. Right? You have to make sure that you're still protecting yourself. So stock wise, if I'm looking at it, I would think more so in the terms of maybe 20-30% more speculative, if that's high. And then the other 70, 80% being your more secures. You're more these are undervalued, these are nice solid growth stocks. These are companies that I know have stood the test of time. Microsoft, Apple. You have your dividend companies, the dividend aristocrats, and I'm gonna look that up too, so we can pull that. All right. So you have your dividend aristocrat stocks as well. And these are companies that have increased their dividends every year for the past 25 years. So it's like 2022. All right. So there are certain companies where if you're trying to build a portfolio because you have a higher capital, but you just want to have companies that are paying you out, then you can do this and go and look at these stocks, AT&T, Leggett and Platt, so many, but you can pull up the list of those stocks and make sure you're investing in those. For ETFs, this is another way before I start going deep into a company. If I know that there's certain ETFs that are performing well, or if I know, hey, you know what, we had maybe 2 years ago where oil was, I think, negative. Right? Oil had that huge, drop, and people were like, kind of like, is this the end of oil? Right? And you were saying, hey, you know what? I think oil's going to bounce back. Let me look up what companies are in these oil ETFs and I can start doing my analysis from there. Right. So I'm gonna use USO, which is the United States Oil Fund. Oil was negative during COVID. What up, my guy? Yeah, so that's what I'm talking about. All right. So during that time, during COVID, when oil was negative, right, and that was a great time to make purchases. I told a lot of my family, like, yo, hop on oil, because we were looking for that bounce back. All right. So what you could do is come to that. It's Cat Oil Company. Caterpillar. I don't think they directly are oil. Let me see. XLE is energy. I don't recall the oil. What's the main oil ETF? Spies oil ETF. Yeah, USO. Yeah. ExxonMobil is an oil company, correct. So I'm gonna use this energy one. USO. Okay, so that's what I put up. What up with y'all? What up with peeps in this thing? Yeah, so that's what I pulled up, but it didn't have the holdings that I wanted to show. Oh, so that's why. Okay, so I know what I'm talking about. All right. So if you're looking at something that you're anticipating from some revival in that area, in that sector, was good. Appreciate you, bro. Then you can come and look at these holdings and then go from there. Yo, oil about to make a move back. Okay, we can go buy the ETF, but if we want to get the exposure to the individual companies that are going to make that ETF run, right? This is XLE, the Energy Select Sector Fund from Spider. If XLE is going to make a big move because energy is making a big move, then these companies are going to be what carry it up. And then these are the companies that you could then go in and invest in. Just like with SPY, if we looked at SPY and SPY had a 30% return one year. Well, if SPY had a 30% return one year, what do you think Apple did? What do you think Microsoft did? What do you think Amazon did? Right. So that's another way to not only diversify your portfolio, but you can look at taking top holdings out of top performing ETFs. Again, let these companies do the research for you. At this Spider fund, at this big institution, they're not hiring random people off the street. They're hiring people with the track record. They're hiring people who have done the research, done the analysis, had the schooling, right? All these things to be able to say, hey, you know what? We're managing however many $1 million we're managing. We should put a fourth of that into ExxonMobil for some reason. Right. And so if they feel so strong about ExxonMobil, then it's something that it is at least worth looking into. Is that making sense? Is that making sense? Is that making sense? What's up? Is my fam coming out? Round through a one for this making sense. What up? What up? Love it. Cool. Cool. So rolling back into the diversifying again, right? It matters so much. I feel like I'm gonna keep repeating that. It matters so much what your goal is. But it also matters to not, I'm gonna talk about the negative side of diversification actually, because you have different types of diversification. And so you can have diversification across stocks, but not be diversified across a sector or across an industry. You can have, for a quick example, you can have Dollar Tree, Walmart, Target, Best Buy, Five Below, Dollar General, Macy's, Nordstrom, Bed Bath and Beyond. I think Bath and Body Works is BBWI, right? So you can have all those companies. I might just name like 9 companies or so, and be diversified across those individual companies, but they're all the same. They're all the same industry. They're all the same thing, right? Absolutely, DC. Yeah, they're all the same thing. You're just buying a bunch of retail stores. Right. And so although you're diversified from the company, hey, if the CEO of Best Buy does something crazy and they drop, the whole sector takes a hit, if the economy takes a hit, then you're looking at a situation where your whole portfolio is screwed. Right. We've had times where Like oil, we just talked about. Oil was negative. Oil dropped off the face of the earth during COVID. So if you were diversified across Chevron, Exxon, Next Era Energy, right, all these oil companies, Enphase, First Solar, right, you're diversified across these companies, but your actual portfolio is not. You're still exposed to the same industry risk. So what you can do is look at top performing ETFs, or if you do your analysis, look at what ETFs you're expecting to be top performing. And then from there, take what's the ones that's gonna carry it. Like we just looked at XLE. And we saw that Exxon made up 22% of XLE. So let's look at Exxon being one of our picks. Let's pick the best out of the industry. All right. If we're going to do something, let's go with the best. And so I would say that's one of the ways to truly diversify yourself is go across the sectors, pick what things are top performing in that sector. Appreciate you. Yeah. And CVX. All right. Chevron. Those are the top two. We see clearly that they're carrying XLE. Right. And then from there, so you can take, hey, what are the two best tech stocks? All right, cool. What are the two best healthcare stocks? What are the two best consumer discretionary stocks? What are the two best real estate stocks? All right. Spread yourself out in such a fashion where you're not exposing yourself just to, hey, tech is having a rough year and your whole portfolio is in tech because those are all the popular companies. Right. Another thing to think about is your capital risk and how you're diversifying your capital across these companies. Are you heavy in Apple because your cousin worked there and told you that the iPhone 25 was going to be the slimmest, sleekest iPhone ever? So you just heavy in Apple, but you got this other company, but you know what I'm saying? Your lopsided portfolio is good when stuff is good for Apple, but when Apple takes a hit, your whole account is down and Apple's the only thing that's red. All right. Look for those things. Look for diversification just when you're investing, period. All right. Some people take the approach of, hey, every single day I'm putting money in here, every single week or every single month or every single year, regardless of the price. I take a little different approach. When we were rolling into COVID, I do a overall market analysis where I'm looking at where we're headed. When we're rolling into this stuff where the market was going to drop, it was like a year or two ago. I liquidated all my long-term stuff. It was like January or December. I think I just froze. Bring me back, Wi-Fi. Bring me back. Did I freeze or did somebody else freeze? Oh, I'm good. Okay, Moody froze. I saw Moody's face and he froze. I thought I froze. Okay. Yeah, so 2 years ago, I liquidated everything, but that was right before, like right when we were starting, we had the huge crypto crash. We had a huge stock crash. I got out of everything. Oh, and I was like, okay, cool. I'm not gonna sit here and hold this stuff while it's gonna drop for months. And I'm also not going to buy into it while it's dropping. Now, that's because I'm also able to do the technical analysis to see that. For those of y'all who have followed me or been following me, y'all know that I also, last month or 2 months ago, I called the August top. It was on Instagram. I said, it was in July or June. I put out a reel. Say, hey, within the next couple of months, we're gonna hit like 460. After that, I'm buying puts like crazy because the market is done, right? And that's not to say like I'm some guru wizard or something, but just using your analysis to see what's the bigger picture, and then from there, I'm not adding more money in here. So instead of me switching up and diversifying in a sense where I'm just buying stuff every single week, I'm looking at it to be 457 exact is what I said. Appreciate you. It hit like 459, I think. Oh, but I was like, you know what? Cool. Now is not the time for me to be continuing to put money in the market. It's like if you're in a trade, and that's one of the times where you can compare the two. If you're in a trade and the trade is going against you, would you keep adding money? If the chart is clearly showing you that it's about to keep dropping and you're in calls or you're in a bullish position, would you keep adding money? Like, no, that doesn't make sense. So by the same token, when we're having, hell no, right? So when we're, because you're going to lose more money, you're putting yourself in a spot to continuously lose. And it's easy to fall into the thought of, but if it recovers here, I'll be good. And fortunately, with long term, usually it's going to recover at some point. All right. But how much better could you be off, especially with crypto? I remember talking to somebody with this. Um, Shout out to Moody, actually. I'm gonna tell a story real quick too. I almost bought a Bitcoin for my birthday in 2020, I think it was 2021 or 2022, 2021. I was on Moody and my friend D Wiz. I almost bought a Bitcoin for my birthday. I was in Mexico at a resort. I'm like, bro, so, yeah, bro, but that's a flex, bro. Like birthday Bitcoin, it just kind of goes. But I didn't. I listened to them. I looked at it myself too, and I'm like, okay, yeah, like actually, yeah, I should. All right. And so when you see stuff like that, with Ethereum hitting 10,000 or so, and then dropping back to 5,000, it's like you could have bought a Bitcoin or an Ethereum, a whole ETH for 10,000. Now you can have two because you waited, right? And not just no arbitrary waiting, but strategic waiting, right? Actually looking at the chart, understanding, you know what? I'm going to diversify the times that I'm investing. I'm going to diversify the amount of money I'm putting in. We're at the tops. Even if you have something that's set to auto invest, which is cool, by all means, if you get paid every 2 weeks or whatever the case is, however your money's set up, every week, every day, whatever, certain money is in there. I would even say as the market drops, if you're going to keep auto investing, as the market drops, that's when you want to ramp it up a little more. As the market goes back up, you want to take it down some because now your potential gain decreases. Something just went up 10%. If I just put $1,000 in it when it was at $100, now it's at 110. I don't want to throw another band in there, right? The money I wanted to put the money in when it was lower. I should have been loading up more when it was at 100, when it was at 95, 90, 80. Like when Bowen went from 200 to like $80. That was another, hey, everybody in the family, get some Boeing. Like, I don't know how often we're going to see Boeing at like 90 something dollars. And they're only one of there's two major airline companies that like actually produce the planes that majority of the companies use. Get on it, right? So that's the diversification thing. Think about what your actual goal is. Think about where you're trying to head with it. Think about the timing of when you're entering stuff. Making sure that you're looking at entering when it's near or more closer to a good time to hop in. Right. As the stocks drop, as the market declines, can't you can't dunk on me, bro. As the market declines, that's when you want to look at adding more money into your positions. Use websites like this. Use websites like etfdb.com. Look at certain ETFs. Instead of just buying SPY, go look at what its holdings are in SPY. If SPY is going to be positive, then look at what's going to be the thing to make it positive. If we have something that's really beat up, certain industries or certain sectors are really beat up, go look at what's going to be the thing that brings them back to life. All right. Instead of just riding the ETF wave, get in the stock. You feel me? Late too, bro. Get in the stock. Um, when you're diversifying, don't get caught up in the high risk, high reward type of things, or this thing can pop off. You know, I'm putting all my money in AMC. I'm putting all my money in GameStop because GameStop's going to 500 and 5,000. It's crazy, right? Do some actual assessment when you're looking at stuff. Think about it, and of course you can research, but try to think as logically as possible. Uh, Understand that a lot of companies that had a bunch of hype are garbage companies that were just moving off of hype. TF database. All right. Appreciate you in chat. Right. It's a lot of companies that had a lot of hype. And you could see like, all right, look at the fall off. COVID pump. right? A lot of companies had that. And so still don't shy away from I had this too. Because I do this and it's helped me a lot. Don't shy away from doing your fundamental analysis and still having technical analysis in the equation. Right. Even if Peloton fundamentally was a great company, hey, they're changing the game with their bikes and workout machines. No, even if that's the case, and they have good cash flow and all of that, right? Okay, if you bought it here, still establish a stop loss for yourself because you don't want to buy something that's $120 and be looking at it now and it's at $5. That's the stupidest stuff to me. Sorry. It's the dumbest stuff to me to hold something that is clearly going against you just for the sake of, but it's a long-term play. All right, your long-term play has lost you 95% of the money you invested into it. Right. And this isn't the only company, but I say that because when I first was kind of getting into the market, that was, and granted, I didn't have like somebody like kind of coaching me and guiding me. I had very limited knowledge. It was more so like, hey, stocks go up, invest in what you use. Like you like Nike, buy Nike. We got Colgate toothpaste, buy Colgate, and don't sell. Like whatever you do, like don't sell, it's gonna go up. But that's the stuff that's said a lot, but that's not the best interest a lot of times. Um, yes, you have to actually you have to actively manage your portfolio. Right? It is a longer term thing, but if your long term thing switches, uh, then sometimes you gotta know when to let it go. Right. And it doesn't mean that you can't get back in it. Right. Peloton still do the same stuff. I still see places that got their bikes. One of my friends' apartment complexes, they just did like a whole Peloton gym. It's still a thing. Right. But maybe there's something that needs to go on fundamentally for them to reestablish themselves and start working their way back up. Right. Or if you believe in the company, then hey, good thing you missed this 95% drop and now you can get in and ride the wave back up if that's the case. All right. But it's a lot of companies. It's a lot of companies that you'll see, right, had that going on. Right. And that's stuff that you wanna avoid. GameStop in particular. Um, GameStop in particular is one of the ones where you just gotta think to yourself, like GameStop, they're not selling more stuff. They have done nothing new. All right. And it's people I know who lost tens of thousands of dollars fooling with this. Um, right. SafeMoon. I remember when SafeMoon was a big thing. Everybody, Dogecoin. People were putting their whole portfolio in Dogecoin when they thought it was going to go to $1 and $10. And as again, not to say that it can't or it won't. It's not to say it can't or it won't. All right. But just looking at how you're actively managing, looking at your diversification, looking at diversifying even in that sense where you can diversify into crypto. All right, you don't have to only have stocks. You can diversify into bonds. There's certain times where the defensive plays are the safer ones, and when the economy is booming, you're gonna have more opportunity when you're taking stuff that's a little more risky because now there's more players in the game. There's more people betting. There's more people throwing their money out there. More people are throwing more money out there. There's more opportunity for you to make money if you're smart. All right, so I'm gonna stop the recording right here.